Pensions, pensions, pensions. What, when, why, how? We get a ton of emails every week asking us about pensions. So today we have with us leading expert Adam Rideout to answer all your questions. Hi, I'm Mitch Hahn and welcome to Nordens TV. So Adam, thank you for coming in. Can you tell us what is a pension?
Yeah, okay. So a pension is not necessarily what people think it is. A pension is simply a tax efficient savings plan. All you're doing is building up a pot of money, so think of it as a tax efficient piggy bank with specific rules. You get free money from the government for paying in the form of tax relief. So if you're a basic rate taxpayer, let's say, and paying £80, the government will give you 20% tax relief and make it up to £100. Let's say you're a higher rate taxpayer, you can actually get a further 20% tax relief through your tax return. So it would only really cost you £60. It's one of the most tax efficient ways to save money. And then bear in mind, money inside the pot grows free of capital gains tax as well.
So there's obviously different types of pensions. How would someone know what type of pension is right for them?
Well, that very much depends on, I'd say, a number of factors. Your needs and goals, preference, experience and size of the fund all play a part as to which could be the right pension for you. If you require access to more sophisticated investments, let's say, such as commercial property or individual shares, then a SIPP may be suitable. But bear in mind, these tend to come with greater costs and tend not to be cost effective until you have a certain fund size. If you're just starting out with pension savings and want to contribute a regular monthly amount, you could opt into your employer's workplace pension, bearing in mind that all employers are now legally required to offer a pension scheme to workers through the auto-enrolment programme. Otherwise, something like a stakeholder pension may be suitable, something where you can effectively keep the costs fairly low.
Okay, so how would someone actually make a pension contribution?
You can make a contribution that can be from your personal funds directly, or if you're, let's say, a contractor or have your own business, you can also make them directly from your company's profits. Most limited company contractors will make their pension contributions from their company as it's actually more tax efficient. But to make a contribution from your own personal net pay, the amount that you invest will attract personal tax relief. So that means the pension provider will add basic rate relief from the government and top up your contribution by 20%. You might actually also be entitled to further tax relief if you're a higher rate or additional rate taxpayer.
So different people are set up in different ways. How much tax would someone save on a pension contribution if they do it through their business or a limited company?
Yeah, let's assume you are a limited company director or you're a contractor and you're actually in the higher rate tax bracket. So as a limited company owner, for every £100 your company earns, you have to pay 20% corporation tax, which brings that amount down to £80. You may then need to take this money out of your company, and to do this, most contractors tend to take their income as a mixture of salary and dividends. So as a higher rate taxpayer, if you were to take this £80 as a dividend, you incur dividend tax. However, if you were to invest that £100 into a pension, you can contribute the whole amount, and once in a pension, that amount could grow. So it's a very tax efficient method of extracting profits from a business.
So probably the most common question you get asked, how much would a pension grow by?
Okay, yeah, so that's a bit of a misconception as to what a pension really is. What you will get back will depend on how much you put in and how much the investments you choose will grow by. As I said earlier, a pension is just a savings account. It's what you actually invest in and what's inside the account that counts. So the return your pension investments will make will depend largely on what you choose to invest in, whether that's, let's say, shares, bonds, property, and how the markets perform.
So if anybody were to take out a pension or opt into a pension, what should they actually invest within one?
That will largely I'd say depend on your attitude to risk, how much loss you can tolerate, and how long you have to retirement. A general rule of thumb is that if you're at the outset in terms of saving for retirement, then I'd say investing in assets that have a higher expected return over the long term would be wise, such as equities. However, the closer you are to retirement, you may not be able to tolerate the risk of your pension fund losing value, and so having less volatile assets such as bonds may be more appropriate. Having said all that, selecting the right investments can be a really complex area, and so I'd always recommend speaking to a good financial planner if you're unsure what is right for you.
So that's covering how to put money into a pension and why you should put money into a pension. Taking it out, that's an area I'd like to cover now. When and how does someone start withdrawing from a pension?
Yeah. For any personal pension arrangement, you can start withdrawing the funds from the age of 55. That could be used to help you retire early or to top up your income if you're still working. So in terms of taking your money out, the pension freedom rules that were introduced last April mean that anyone aged over 55 can take their pension fund in effect how they want, whether that's a lump sum, an income, or a combination of the two. However, I would say that people should be mindful of the tax implications of how they withdraw their pension fund, and I'd really always urge people to seek proper financial advice before doing so.
Yeah, I agree with that too. So, Adam, tell me, is a pension worth it?
Okay. As I said earlier, there's a lot of misunderstanding out there, I think, as to what a pension really is. As I said, it's simply a tax wrapper to save money for retirement. I think the negative press that people may have heard surrounding pensions really comes from certain investments within people's pensions that maybe don't pay off or have high charges. But the real boost of a pension is the tax relief on the way in, and then the tax-free growth while that's invested. I'd say pensions should be a core part of anyone's long-term planning.
Okay, so here at Nordens, we've got a lot of clients who already have a number of pensions or one pension, depending on how they're set up. They may not know much about it or how they're performing, and they don't really know how to keep track of them either. Mm-hmm. What's the best thing for them to do? And is it right or easy to transfer to another pension?
Yeah, okay, good question. I think firstly, you have to consider why you want to move your pension. So, like you mentioned, is it to get a better investment performance or to lower charges, to boost your income, or is it to keep your pension savings in one place to make them easier to review and monitor? You then have to consider the downsides. So, potentially you could get hit by penalties on your existing fund, lose certain guarantees from that existing pension, or even pay over the odds for advice, or be switched into a higher charging product that just isn't necessary. And bear in mind, if you're quite close to retirement, you might not have time to recoup the costs, even if you move to a better performing fund. So I'd say with all things considered, there might still be grounds for you to transfer or consolidate your pensions, but again, this is a complex area. And I'd say you would nearly always need to take formal financial advice and for an advisor to transact a pension transfer on your behalf.
Okay, that's good. So finally, how would someone start up a pension?
Okay, so I'd say a good starting point is if you have an employer. See what your employer offers. It's a legal requirement now for employers to automatically enrol or offer a scheme to their employees. Larger employers are already doing this, with smaller ones expected to be on board by 2018. However, if you're self-employed or run your own business, then you could source this yourself. Many of the well-known insurance companies offer personal pensions, plus do-it-yourself SIPs are directly available for consumers. However, to be careful to know what type of pension is best suited to your needs, that the charges are reasonable, and then work out what to invest in, I would always recommend talking to a good financial advisor who can talk you through the process.
That's great. Adam, thank you for coming in, answering questions. Good to see you.
Thanks, Mitch.
Wow, that is a lot to take in. My recommendation is you must speak to an expert. If you don't have a financial advisor or you just want some advice, give us a call, drop us a mail, and we will be more than happy to help. Our details are coming up on the screen.